Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me today would be Michael Becker, but Michael Becker is in the middle of a due diligence of a property that his group is looking to purchase. So good luck to Michael on that one. Sitting in the podcast today is going to be Jonathan Farrell, a teammate of Old Capital. So Jonathan, how are you?
I'm doing well. Thanks, Paul.
And we're going to talk a little bit about a deep value-added property today. So a deep value-added property. So a deep value-added property is what many in the apartment investors would like to pursue. Now I want to highlight the words would like to, as in they would want to purchase a property that had a large potential economic upside if lots of the physical needs and management problems were cured. Problems could be poor management, bottomless, deferred maintenance, roof leaks, bad tenants, you name it. The cure would be updating the asset with new appliances, fixtures, and paint. If the submarket concludes that you could get much more higher rents with a better product, you will be able to charge a higher rental price to justify the rehab dollars spent. Of course, you'd figure that out right before you bought the asset and prior to the rehab construction, provided that the bones of the property were okay and the location of the asset was good. It's really a property transformation. So I'll give you an example. I remember a television program called The SWAN. Jonathan, do you remember The SWAN?
It's probably before my time. No, I remember it.
Yeah, I don't know if you remember seeing it, but it was a long time ago. But they took a woman who was judged to be ugly. They could have taken a man, but they took a woman that was judged to be ugly, and she was given an extreme makeover. So extreme makeovers were in the form of plastic surgery, dentistry, and weight loss. So we saw some incredible transformations happen when that person had that extreme makeover. They were making the ugly duckling into a beautiful swan. They were transforming it from a beautiful person on the inside to a beautiful person on the outside. In a value-added apartment transaction with the help of a lot of money and a dedicated team of patient investors, you are transitioning the asset from the ugly duckling to the beautiful swan. You don't just change the outward appearance of the asset with exterior updating and additional amenities like sand fire pits or sand volleyball or package lockers or valet trash and covered parking, just to name a few. You make sure that the new management company has your vision. You share with them and you communicate with them to help the current tenants and the new tenants about the new changes that's going to happen and what can be expected. So we need to transition bad tenants out and with new tenants coming in. So in with the new, out with the bad. The new tenants won't have the baggage of the memories of items not being fixed or having old management being permissive with bad tenant behavior. So by executing your plan, you should be able to increase NOI and increase value, significantly increase value. So in the podcast today, we have Brian Holly, and Brian is working on a deep value-added property. He purchased a 160-unit apartment building in DeSoto, Texas, and he's spending over $20,000 a door in capital over the entire property. So $20,000 a door. So we want to hear his story about transforming the ugly duckling into the beautiful swan. So welcome to the podcast, Brian Holly.
Thank you, Paul. Appreciate the opportunity to be here and talk about my swan.
So tell us a little bit about your professional background. What do you do or what did you do?
Well, my professional background is actually in marketing and management, and I'm still involved to some degree on some large projects for a large international company.
No kidding. So why did you get into multifamily?
Well, I've always been interested in real estate, and I had done some single-family investing on my own, and then got familiar and acquainted with lifestyles, and it was just a transition to multifamily.
And Lifestyles is the mentoring educational company?
Absolutely. Lifestyles Unlimited, you bet. And just naturally positioned myself switched from single family over to multifamily, primarily for the economies of scale.
So Are you still with Lifestyles, or have you gone on, or what's your status with them?
I still am a Lifestyles member, absolutely.
Okay. So do you have a mentor that you work with? Is that how that works?
I do have a mentor at Lifestyles, but to be honest with you, my multifamily mentor for the most part is Darwin German.
Okay.
And Darwin has been very successful in multifamily investing, as you know,
Right.
and is currently my mentor in that field.
Okay. So before you took on your own transaction, were you a passive investor?
Absolutely. I was a passive investor and really used that opportunity to learn all I could about multifamily investing. And then again, the next logical step for me, what I found out was that I really enjoyed the business, especially from a standpoint of taking a project from inception to completion. So once I realized I enjoyed that, then the next logical step for me was to become a lead investor.
Okay. So what was your motivation to become a lead investor? Was it the money? Was it the opportunity to kind of put these deals together? Tell us a little bit about why you became a lead investor.
I think it was all of the above, to be honest with you. Certainly the money was appealing. Certainly the information that I learned from Lifestyles through their mentoring program. And then being a passive investor certainly provided me the opportunity to learn more about the business. And again, found out that I really enjoyed it and wanted to continue in this business.
Is your wife involved in the multifamily business? Is that something?
My wife is involved in every facet of my life. While she is not personally involved at the property level, she's certainly my support. She's certainly a financial partner and the person that I speak with every night on different ideas and different thoughts about properties.
Yeah, she's a very sharp woman. She's a banker. So she's no dummy. So
Absolutely.
Yeah. So let's jump in. And we brought Jonathan into the conversation because Jonathan really was the person who did your loan. So he's going to have some more information about how that transaction was structured. So Brian, what's the name of the property in DeSoto?
When we purchased the property, it was Brook Hollow, and we have rebranded and renamed it to Riverbend.
And why is that?
To be honest with you, the property had a very bad reputation in the marketplace, and we knew we needed to rebrand it and give it an entirely new name. So in addition to all the rehab and everything that we're doing to the property, we wanted to give it a new name. It has a fairly large creek that runs right through the property that actually splits it in half. So that's where the name Riverbend came from.
Is it in a flood zone?
It is not in a flood zone. It's actually not even in the 500-year flood zone.
But there's a creek that goes right through the middle of the property.
Absolutely.
Okay, I get it. So how did you find this property? How did you make this opportunity come together?
We got the information from a local broker here in the Dallas-Fort Worth area that we do have a lot of contact with, and he brought this property to our attention.
Okay. How far away is your house from this property?
My home is almost exactly 35 miles from this property, so a very easy commute for me.
So 35 miles from the property.
Correct.
Okay. I thought you were right down the street, but I guess you're not.
No, about 35 miles, but
that's not
easy commute.
So how would you describe the initial condition of the property when you guys bought it? And again, if you can't say something nice, don't say anything at all, as I think my mother said. But,
Absolutely. No, I'll be kind. I mean, the bottom line is the property was in poor condition. It had a lot of deferred maintenance and had just been neglected for a while. So I would classify it as poor condition.
Jonathan, how would you classify the property?
This is one of those properties where you really have to focus on the vision of where this property is specifically located, but certainly, I'll use a phrase, it was the dog of the market. I mean, but again, it was just, it's a deep value-added transaction that a lot of investors weren't willing to take on, but certainly had a huge amount of upside to it.
So when you bought the property originally, Jonathan, what did you notice about the property?
I needed to notice, certainly when we were inside, where I was putting my feet. There was actually holes in the floor. This was a pier and beam construction. If any of you have kids, this is one of those indoor trampoline parks. The subflooring was very squishy and a lot of movement where there shouldn't be movement. But again, good bones and good location. Anything else that stood out on that property, Jonathan? The creek is, from an exterior standpoint, it's an unusual thing to find, but I thought it was certainly one of those where obviously you can't duplicate that. So it's from an amenity standpoint and just something to add to the property that, again, can't be duplicated. I thought that was a great asset to have. Yeah, it would be a great asset to have. It wasn't full of garbage. Very true. Yeah, it was. It needed a little bit of cleanup, but again, all these properties do. Okay. So, Brian, how many properties did you and your group look at before you found this one?
Several, at least 3 or 4 or 5 other properties before we landed on Brook Hollow.
Did you do a lot of underwriting of every property you looked at, and did you submit offers in on several transactions before you found this one?
I personally did not. Certainly looked at several and looked at the numbers and analyzed each one. But again, I did not put any contracts on other properties, no.
Yeah. How would you describe the market right now in terms of trying to get a property these days?
Right now, it's really tough. Things are overpriced at this point, or in my opinion, are overpriced. It's really tough to find the good deals that I'm looking for.
Yeah, and this is a deep value-added property. So this, the bones of this property were pretty good. We're in pretty good shape. So,
Absolutely.
So I don't think you would have taken this opportunity on if the bones weren't there or if it wasn't in the right sub-market. So you would have had challenges with the demographic of the property because you can't change the submarket. You can change the property in the submarket, but you can't change the demographics of the submarket all by yourself.
Absolutely. We were actually excited about the location of the property. There were several other well-performing multifamily properties in the area. Great amenities around the area as far as great shopping, parks. And one of the things that excited me about it was the property is heavy with 3 bedrooms. And there are many, many family opportunities around the area, which excited me.
Yeah, let's talk a little bit more about the property because it's 160 doors or so.
Correct.
And it is 2 stories. And how many buildings are there? Do you remember?
Actually, 20 apartment buildings, and then a separate office building and a separate clubhouse/maintenance.
So every apartment building usually had 4?
One has 4. Some have 10. Most have 8.
Pitched roof or flat roof?
It's pitched roof.
Individual HVAC, or is it on a chiller system?
Individual HVAC on a boiler system.
So, and again, if you were describing the property, was there a pool on the property?
There was not a working pool on the property. There was one that was underground, and we're not adding it back in either.
So when you say underground, what does that mean?
It had been filled in for many, many years before we purchased the property. The coping was still sticking out above the ground.
So there was dirt in the pool, but there was no water in the pool. But you could see where the coping around the pool was never collapsed or crushed.
Absolutely correct.
Interesting. So on a scale of 1 to 10, 10 being the best, what would you kind of rate that property on your acquisition?
At the time of purchase, I would say a scale of 1 to 10, with 10 being the best, I would rate it between a 3 and a 4.
Did you have to replace any of the roofs at all?
We replaced every single roof on the entire property.
So what type of physical due diligence did you do on the property? Did you bring out a crew to take a look at the roofs or the HVACs, the parking lot, the crushed pool? What did you guys do to do physical due diligence?
Great question, Paul. We put together a team. That team consisted of a very trusted contractor. Mm-hmm. It consisted of the management team that was going to be managing the property.
Yep.
Consisted of an asset manager that's part of our team and myself. And we went through, to be honest with you, and walked every single unit, all 160 units, and did a very thorough assessment of the condition, both inside and out, talked to residents. You name it, there was no stone left unturned. And that's really the way you have to do a deep value opportunity.
When you guys were buying the property on the front side, what was the occupancy of the property?
94%.
So 94% is pretty good.
Sure.
So, it's tough to bring it up to 99 or even 100. So how would you kind of rate the tenants at that period of time?
Well, there's no question that the property was a low C, maybe a high D property.
Okay.
And our goal and what we've been able to achieve is get it up to a B property.
So because there's a property right across the street from the subject property, and how would you describe that property?
I would classify it as a B property.
So just right down the street, within 100 feet or so, there's a competing property, I would imagine.
Actually, 5 or 6 pretty close to that area.
But your property was so low on the scale that really the property next door wasn't a competitor to you. It would be where if you couldn't get into that property, that you could go across the street and get into your property for tenants. Fortunately, that's going away. And now you're going to create that beautiful SWAN property that you're going to take this property to even a better looking property than the property that's across the street from you.
Absolutely. There's certainly no question. I think Jonathan used a good term. It was the dog of that submarket. Yeah. And it was not competing at any level with the existing multifamily that was around there. Obviously, it allowed us what the great opportunity that I saw and that we saw was that at our acquisition price plus the rehab, we were then in a position where we were still a little bit less on a cost basis than the other multifamily properties were selling for in that area.
Wow. Wow. When you put together the contract, did you have to go hard with earnest money?
Absolutely, I did.
So was that a large number, or was it like $5,000? Or, how big was that number?
It was a big number, Paul, but I got to give you just a little bit of a background first in that we actually looked at this property a couple of months prior. And we did the due diligence and did some analyzing. And to be honest with you, we passed on the property to pursue another property. When that property didn't work out for several reasons, I went back and renegotiated a different price with the broker. And at that time, since we had already tied it up once, at that time, certainly the requirement was, but I personally put down $150,000 hard money on day one.
That's a big number.
It is a big number.
How long did they give you to close? Was it close in 30 days, close in 45? How long? It was a threshold that you had to keep pushing more money over to them?
The term was $150,000 hard money on day one, 30 days to close, but with the ability to have two 15-day extensions, and each one of those extensions was another $25,000 hard money.
Wow. Like I mentioned before, your wife works for a regional bank in the area, and you spoke with them just to get some kind of feedback on what was competitive out there for rates. Tell us a little bit about working with, say, a regional bank. How did you find that to be?
Well, I would tell you that it was a good and a learning experience, but what I soon learned and soon found out was that it was just not in the wheelhouse of the regional banks.
Yeah.
It was not anything that they had any familiarity with, certainly nothing like that in their portfolio, and it scared them a little bit, to be honest with you.
Just doing a deep value add, or just doing multifamily, period?
A deep value add multifamily.
Yeah, they just couldn't, they're probably good at maybe doing office or retail, for owner user, but they probably don't know a lot about commercial real estate investment property, and they probably don't know a lot about multifamily and the deep value add because they probably haven't done it.
That's absolutely correct. Very nice to work with.
Yeah.
Just again, it was not anything with which they had any familiarity.
All right. Well, let's talk with our star, Jonathan Farrell. So, Jonathan, tell us a little bit about the loan that you put on this property. So, Brian had talked to his wife's bank to get a little bit of understanding about what's going on. Again, people come to Old Capital because our depth of knowledge of what works and what doesn't work. Brian came to you to kind of figure out what we could do. So, talk a little bit about what type of a transaction you saw. How was it put together?
Sure. So again, we've touched on this in podcasts previously, that when lenders are looking at sizing these things up, and if this is something they want to do or not, assuming they have the appetite to even do it and the knowledge to do it, they're looking at this from 60 to 70% of this underwriting is going towards the property. What is it today? Where can it go? And all the metrics that go into the underwriting. But on the other remaining percentage, 35, 40% of the underwriting is going to the sponsors. Who's the lead sponsor? Who's the team? Who's the property management company? Who's the contractor that's going to get in and do the heavy lifting? So this is something where, again, Brian had the ability to come in and partner with Darwin German. Darwin is well known in the B and C multifamily community, has taken on properties like this, has owned properties in that submarket, and had a depth and knowledge of just an actual working knowledge of that environment.
If Brian by himself came in, do you think we would have been successful? Brian by himself, having limited experience of doing a value-added property?
It would have been a challenge for sure. And again, just kind of knowing where you are in your career path and doing this, and knowing that you need to partner with the right guys, knowing that you may have limited experience yourself, and understanding again that lenders are looking for that. Could we have gotten it done? Maybe, but it would not have been structured the way it was. It would have been a lot lower leverage and other credit enhancement that would have had to been in place as well.
What were some of Brian's criteria that he had to have, and then talk a little bit about the way that you guys structured, or how Old Capital structured it?
Yeah, so this one went to a regional bank that we've done a lot of business with in the past. It has a large appetite for value add opportunities. We traditionally go to this bank for non-recourse bridge financing. When it comes to non-recourse bridge financing, to put it on a scale, to get those types of properties done, it can't be too hairy and it can't have no hair. If it doesn't have enough hair to it, then there's other more attractive lenders out there with better terms, better leverage that can get that property done. Fannie being one of them. Occupancy is above 90%. They can roll in some rehab dollars to get it done, but it's got to have some certain economic components to it to get it done.
Because Fannie's not going to do a large $20,000 door rehab, even though the property was 94% occupied. When you're looking at doing a devalue added property, rolling the rehab into the deal, that's not what Fannie Mae does. They're looking for stabilized properties, maybe doing some just minor interior, exterior upgrades, maybe $5,000-$6,000, and you have to have almost the property cash flow itself with those repairs to be done.
That's right. The opposite side of the scale is too hairy, right? There's just too much problems with this property. The occupancy is not 94, it's 60, 70%. The cash flow is just not there. And ultimately, that's what all these lenders are looking at. How do we get this loan repaid? And if it's not today because of in-place cash flow, how quickly are we going to get to, a point of stabilization? And just kind of, again, structuring from A to Z of where we're starting and where we're finishing off. So, again, we went to a lender that we work with quite a bit. And if we can, if the metrics allow it to, we generally start off non-recourse. But they're looking for certain cash flow metrics on the front end to be able to service the debt. And then ultimately, certainly want to understand the plan of action. How much are we spending? How fast are we going to spend it? How is it going to be spent as far as exteriors, interiors? And show the timeline from day one when we close. This one had obviously a robust rehab component to it, a significant amount of money. I think it was over $3 million, close to $4 million. And so the lender wanted to know, okay, here's the in-place cash flow today, and you're going to be spending X amount of dollars over the course of the next 18, 24 months. Are we going to spend $1 million in the first 2 months to address severe deferred maintenance that needs to be addressed from a safety and soundness standpoint? Are we going to trickle this out pretty slowly over the next 24 months? And if so, obviously it's going to be a component of how the cash flow is reacting to the rehab that you're doing. So as you know, on the front end of these things, especially a property like this, there's a lot of exteriors and deferred maintenance that just needs to be addressed immediately. And so you've got to spend those dollars day one without really any effect to cash flow. And if anything, it's going to go down a little bit because you've got to, as we talked about, clean up the tenant matrix. So you're likely to see that 94% occupancy dip down. How far and how fast, that's up to the strategy of the property. But in a case like this, it needs to be fairly quick. So all that to say is this did not qualify for non-recourse upfront day one. It needed credit enhancement. So this is actually a recourse loan. But once the property hurdles back to certain performance metrics on the backside, so once the rehab's being done, NOI is trending up. Once they hit, again, certain performance metrics, it converts to non-recourse. Okay. So it does, without having to go back to the bank and requalify or reappraise or anything like that. They built it in up front that once that hurdle is met, it'll convert to non-recourse.
What did you think about that transaction?
Well, I was actually very pleased. I mean, Jonathan obviously did a great job educating myself as well as my team on that. And to be honest with you, if it wasn't a property that I was not willing to guarantee, then it wasn't a property I was going to get involved with to begin with.
Tell us a little bit more about that loan. I mean, how was it structured again? What leverage going in on the deal? Because, I mean, this property, you were going to bring it down from 94, and where did it eventually go to? What was your low point?
About 71%.
About 71% occupancy. But we already knew that going into the transaction. The bank understood that was going to happen. And to make it non-recourse, we can either hold a balance sheet as collateral, or we can hold the property without the balance sheet as collateral. And so right now we have the balance sheet. Your investor's balance sheet is collateral until you can prove up your plan, and then it'll modify over just to the property itself, and the balance sheet will drop off after you execute that. Anything more to add to that? Yeah,
I mean, you asked about leverage. So, I mean, we ultimately gave a loan commitment of up to 75% of the cost. So, again, cost being acquisition plus the rehab dollars to go into it. So, the way that it gets structured, though, it is 75% commitment, but we're funding out the rehab from the loan. So it actually goes into it's a lower loan basis for the lender up front because all the cash is going in up front, all the equity. So again, that kind of gets them comfortable that, okay, our basis is low, it's a broken property, But with the sponsorship team in place, and again, sponsorship being, Brian was the only new guy at the table, really. He built out a phenomenal team around him. Darwin German, very familiar with that bank and him as a sponsor. The management team that was in place, the bank had done a lot of transactions with in the past. So it's important to have that built-up experience and just seasonedness with a lender that they can go to their credit committee and go, hey, guys, I know this transaction is again the dog in the market, but we've got a great sponsorship team in place. We've got low leverage going in, but we've got his historical track record that these guys know what they're doing.
And you got some interest only on that, and that term was what, for 5 years too?
5 years, 2 years of interest only, I believe, and 30-year amortization once it rolled out of the interest only.
Wow, you checked all the boxes.
I did.
He was good to us.
That's good. So again, how many loan guarantors were people that signed on this deal?
4 total loan guarantors.
And how many investors did you have?
A total of 44.
44.
Yes.
And how difficult is it to raise capital these days? How difficult was it to raise capital for this deep value-added property?
Well, I would tell you that Jonathan hit the nail on the head when he said I was really the only kind of the newbie at this project.
Yeah.
Having said that, the team was in place, and to be honest with you, it was very eye-opening to me, but it was not really that hard to raise the funds. Darwin and his team have a pool of investors to draw from, and we went to them with a $3.2 million capital need, and it was funded within a week.
That's pretty quick.
It's quick. It checked the boxes, too, for things that people were looking for. You mentioned at the beginning of the podcast that a lot of investors are looking for a deep value play, and there just wasn't any of those going at the time.
Yeah.
So we had good timing as well.
And, you have to train investors what to expect and put together certain expectations, because this property is not going to kick off cash flow for a while, because all the money is going back into the property to make it into the beautiful SWAN that it's going to be. Was there very much pushback about trying to get a preferred rate of return on the money immediately, or not so much? Did people know?
The people knew. Again, most of the investors in this pool were seasoned investors. They certainly knew what they were getting into. Patience is the key word.
Yeah.
We certainly gave them a pro forma plan, and they're holding us to that plan, and we're meeting that plan. But they were seasoned investors, knew what they were getting into.
And you put together a PPM, a private placement memorandum,
Absolutely.
To SEC. That's good. So let's talk a little bit about where the money all goes to. So, Jonathan, you said what, $3 million?
3.2 roughly.
And then where's the money going into?
It would probably be easier for me to tell you what wasn't needed than to tell you what is needed. But just real quickly, I mean, it all adds up to about $13,000 per door for interior rehab.
Okay.
And about $7,000 a door for exterior rehab. But it needed everything. Again, all the roofs were replaced. They were all leaking. All of the roofs were replaced. The parking lot needed to be redone, repaved, restriped. The entire property needed to be painted on the exterior.
Wow.
Every balcony and patio had to be totally disassembled and rebuilt from scratch. The office had to complete remodel, clubhouse maintenance, complete remodel. Again, everything from sheetrock repairs to the interior to new lights, new cabinets, new flooring, new granite countertops. You name it, everything was needed at this property. I think it's the best way for me to sum it up.
Wow, you are unbelievable plastic surgeon putting this property, this ugly duckling, into a SWAN. How's it going so far? I mean, how much more time do you have to go with this rehab?
It's actually going very well. Of course, we took over the property at the beginning of March 2017, so we're about 6 months into the process. Exterior, we're about 90% complete. So 98% of the exterior rehab is complete. So when you drive by the property, it looks like a brand new property.
Fantastic. Who manages the rehab piece of the deal? Is that something that you do, or is it the management? I mean, you don't manage this property yourself, right?
I do not manage the property myself, no.
So does the management company that you hired manage the construction piece too, or how does that work? Or do you hire a contractor to do that?
It's a cooperative effort, but one of the things, as Jonathan mentioned, I was new to the game, but one of the things that I brought to the table was that I was going to manage the rehab. So I manage the total rehab process as what we call a project manager on a daily basis.
That's really what you are in real life. You're a project manager, so you're very good with Excel reports, and you know exactly what needs to be done in a certain time, and you kind of work through that. So that's great. Tell me a little bit about your property management company. They're on the property. They do all kinds of stuff. Do they push out monthly reports to you that you review?
Absolutely. Not only are they very good at compiling the information in the monthly reports, we then take those monthly reports and I add a rehab update monthly report to that as well. And we push that out to every single partner investor on a monthly basis.
Now, when you guys were about to buy the property, I'm sure the third-party property management company went out there to do some analysis on rents. What did they find in terms of your property at the beginning? How much could you raise rents after it was all finished up and new countertops and new cabinets and all kinds of stuff? How much higher could the rents go?
Good question, and you brought up a good point, and I want to really stress that the management company was in on the process from the very beginning, as opposed to going and buy a property and then pushing something on a management company. We felt like it was very important to have them there from the very beginning. Bottom line is the property was operating at 84 cents a square foot when we purchased it. And we put a pro forma together that would work for our plans to get the rents up to $1.05 per square foot. We're actually just a little under $1.10 today.
That's great.
So you can see the cushion that we had there.
That's pretty strong. I would think that. What is your role today? You're project manager of the rehab. What else do you do?
Well, in addition to making sure, and Jonathan mentioned it as well, the way the loan is structured, the pacing is just as important as the quality of work that's being done. So, Again, on a daily basis, I work with the general contractor and the workers that are there. There are 15, 20 workers there every day working on the property. So my job is to continue to set expectations on the quality of the work, but also make sure that the pacing of the project is at a good pacing so that we can make sure we're meeting and satisfying the terms of the loan. That entails working very closely with the management company on a move-out strategy for those moving out, as well as setting goals on the new leases we have to have on a monthly basis.
How much time do you spend on the property, would you think, right now?
In the beginning, I was literally there 4 or 5 days a week early in the process. It's to the point now where I'm there a few hours, 2 to 3 days a week.
No kidding. Jonathan, anything more to add on the transaction?
Yeah, I mean, if it's not kind of making itself clear now, on the lending side, it's extremely important to not just getting to the closing table and having a good relationship with the lender and rounding out your team, management company and the sorts, but after you close, lenders, I think I may have said this before, lenders do not like surprises. Obviously they're not going to be down there on the site daily like you are. And again, this particular lender we closed with, they structured a loan around a plan. Again, Brian, you worked with your management company ahead of schedule, ahead of time, ahead of closing to map out kind of the playbook. How's the next 18, 24 months going to look on a month-by-month basis? And so, again, the lender's structured around that plan. And again, built-in cushions. Obviously it is a playbook. We don't know how the game's going to go, but we have an idea of how we want it to go. And the one thing that no one can underwrite on the front end and know going into the deal is what you don't know what you don't know yet.
Right.
You can do all the due diligence in the world, but inevitably there's going to be something that comes up that you didn't plan for. So again, these rehabs are structured with that in mind and built with cushions that say, okay, if you're going to be at this type of performance hurdle at month 6, let's build in a little cushion to that. Maybe you don't get the rents as that you thought you were going to get, or maybe you need to spend the money a little faster than you thought you might need to.
How much does the lender put into the pro forma on the deal and the increase of rents? I mean, you may, Brian, as a sponsor, said 110 or 115 for rents, which could have been higher. And we kind of figure out, I guess, is it the appraisal that kind of gives them a little bit to justify that it's going to be up that high? So my question really is how much does the lender buy into what the pro forma is?
A huge amount. Again, earlier in the process, before the appraisal's even done, we're using the management company's figures at face value. And obviously, this lender has done a ton of multifamily, and so they can compare it and obviously know what the market is for other projects that they've lent on in that market. So they have an idea of what the number is. But obviously, that needs to be supported by the appraisal. So if we were underwriting to $1.05, as Brian said, here's our stabilized numbers, and the appraisal comes back at the best that submarket is getting is 95 cents a foot. Obviously, we're gonna go to 95 cents a foot.
That's right.
Now, if the appraisal comes back and says the market supports $1.15, that's great. Obviously, we now know that $1.05 should be easily achievable, and if not better. And so obviously the story that lenders love when kind of we get through the end of this rehab is, okay, how did the plan go? We thought we were going to get $1.05 and it was going to take us 18 months to get there. And now we love the under-promising, overachieving kind of performance. Yep. So again, you're able to come back to the lender and say, hey, we got $1.15, and we did it in 12 months, not 18. Yeah, we ran into some hurdles here and there, but we managed it. But again, the whole thing is, if something happens and the unknown happens that you didn't know going into it, and it just changes the strategy of the property and the rehab, go back to the lender. And that's why it's important. We started off with, again, you visited with a regional bank, that it's just not what they do. There's nothing wrong with that. There's a lot of things they do a lot of things good at, but it's important to pair with a bank that understands how these things happen and are more business minded and real estate minded versus just bankers. They can come back to the table and say, okay, guys, it is what it is. Let's figure out how to get out of it and figure out where we go from here. There's more than one right way to do strategies. It's just everybody needs to know what the strategy is.
So let's talk about returns, Brian. This is a value-added property, so it's in a transitional phase right now. When do you expect positive cash flow on the property?
You're absolutely correct. It's in the transitional stage, but we expect distributions to go to our partners before the end of 2017.
Oh, great.
Absolutely.
That's pretty quick.
Yes.
On a deep value property. Do you think you're going to keep this asset when it's stabilized, or would you think about selling it? Where's your head at right now?
Well, I would tell you that obviously it's just going to depend on where the market is at that time, but I would tell you that our management strategy is to manage it so that both options are available to us.
That's good. So as a deal sponsor, what's the most challenging part of the business right now?
I think it's just from my standpoint in regards specifically to Riverbend, it's just to keep all of the partners and the investors on the same page.
Right.
Again, there are 44 different individual investors who are out there trusting me and the team on a daily basis. Patience is the key word because it is a deep value and there is a transition period. It takes a little while to see those tangible results and certainly takes a while before you see any returns coming back. So the biggest challenge is just keeping everybody on the same page, keeping everybody motivated in the same direction. But our monthly reports that we send out to the investors, as well as we'll have at least twice. We've already had one, but we'll have another time where we ask all investors to come to the property and look at it themselves.
That's great. So in a typical week, what is one or two things that you do and spend time on?
The biggest thing that I'm spending my time on now is just, again, continued reinforcement as far as the quality of the work, and then just a constant supervision of the pacing of the project. I know you've heard me say that a couple of times, but as Jonathan will tell you even more than I can, the pacing is very important, the way the loan is structured. We would love to go in and do 160 units in a month and get it done, but there's no revenue coming in if you're doing that. So the pacing is very important so that we keep the revenue in the property, but at the same time turn it fast enough so that we can get the rents where we need them.
You've done this for a couple months. Any funny stories, whether it is tenants or contractors? Can you think of any funny stories at all?
No, right off the top of my head, I think probably the only thing that was a little unique on this one, and Jonathan mentioned it at the very beginning here, that when he visited the property, one of the things that we look at in due diligence is what condition is the property. And part of the negotiating phase was going back to the previous owners and saying, hey, this is what we're seeing and this is what we're offering. And I tried to tell them that there was a couple of several units that did not have any floor, that were dirt floors down to they repeatedly told me that was not the case, but it was. And I think it surprised Jonathan when he walked in exactly what he saw.
So what do you think investors in multifamily, some of the deep value stuff that you're into, what should investors know going in?
I think the biggest thing to know, again, is just the word patience. They have to understand that there's a fairly lengthy transition period. And again, the tangible results, you can see the tangible results on the outside of the property really quickly, as Jonathan said. But to get it turned around where we needed it to be, to perform to the pro forma numbers that we have, it's all about patience. Just understand that this is not an overnight project. This is a 10 to 15 month project for us to get this rehabilitated.
So what has investing in apartments done for you?
Well, it's opened up a whole new world for me, to be honest with you, both in a financial and in a personal growth. Learning something that I didn't have any experience in. And again, the last 5, 6, 7 years being teamed with Darwin has provided me with that opportunity. But certainly from a financial standpoint, it has provided opportunities. And then from a personal growth standpoint.
Would you recommend other investors to invest in apartments?
Absolutely, I would. I learned a lot as a passive investor, and I would recommend that that's how you get started. But absolutely, I would recommend it.
Jonathan, anything more to add to the conversation?
I don't think so. I think, Brian's one of those shining examples of just surrounding yourself with the right people, knowing the right people, partnering with the right people, not only from the sponsorship team, but then also partnering with, again, Old Capital. We know the lenders that can work on this type of product and have an appetite for it, and we can get a loan structured for it. Obviously, this is a heavy, deep value property. I mean, $20,000 a door is no insignificant project to take on. I mean, we start calling value add at $5,000 a door. So we kind of blew that out of the water. So, and again, it needed it, but with having the right team in place and being partnered with the right lender, this is going to be a successful project.
So next few months, we're going to see this ugly duckling turn into a swan?
I would love for you to come out and see it. Absolutely.
Last thing, back to Jonathan, this lender that we did this transaction through, do they just do it in Texas, or do we have other lenders that go in other parts of the country too?
Absolutely. I mean, this lender that we went is certainly a Texas-centric bank, so can cover the state of Texas pretty easily and surrounding states. But we have lender resources and underwriters that go nationwide.
Right. Typically, you need $3, $4, $5 million minimum loan size.
Correct.
Okay. Brian, if someone wanted to get a hold of you, what's the best way of getting a hold of you?
I'm glad you asked. I would love the opportunity to talk to any of your listeners about this project or about multifamily investing in any shape, fashion, or form. And I would invite them to contact me via email at Brian, Brian, P as in Paul, and then Holley, Holley, at gmail.com. So Brian P. Holley at gmail.com.
I think what Brian talks a little bit about, and we are a big believer, is that you need to have qualified teammates, whether it is investors on this property or if it's an attorney, a contracts attorney or a broker that brought you the transaction, or a physical needs engineer, a contractor. You need to have a great team around you. We do not do these transactions in silos, that you do everything yourself. You need to have trusted teammates that you can work with, that you can rely upon. And within that vein, we're announcing today our keynote speaker for the October 5th Old Capital Multifamily Conference in Dallas, October 5th. Hopefully you've gotten your ticket to go to that. But on October 5th, our keynote speaker, talking about teammates, again, we don't do this all by ourselves. We're going to have a guy named Rob O'Neill. Rob O'Neill. I don't know if that name sounds familiar at all, but he's the last guy that Osama bin Laden saw before he put 2 bullets into Osama bin Laden for all the American people and servicemen. So Rob O'Neill is going to talk a little. Who's a former Navy SEAL. He's going to talk a little bit about teamwork, team building, and we are looking forward to listening to his talk, because he was part of the rescue team for Marcus Luttrell, lone survivor of SEAL team, and then also Captain Phillips. So with the Somali pirates. So some great stories about you just don't do this by yourself. You do it with teammates. Look to get your tickets at the oldcapitalpodcast.com, oldcapitalpodcast.com, October 5th. See if you can make that meeting. That's a good all-day meeting in Dallas. So again, if you want to get any more further information on how to structure these transactions, go to the Old Capital White Paper, the 15-page report about how to structure loans. To get that report, go to the oldcapitalpodcast.com and download that too. So Jonathan Farrell, thanks for coming into the podcast.
Thanks for having me.
And thanks to Brian Holley of sharing his story today. I think it's a great one on the deep value-added multifamily properties. Everyone tries to get those deals. Brian has one. Probably going to do another one here soon. We appreciate your story, Brian. Thanks for coming in.
Thank you for having me, Paul. Thank you, Jonathan.
Again, I'm Paul Peoples. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.